I think that's just one of the sort of timeless facts about superior technology, and I mean technology in a very broad sense. It doesn't have to be digital or whatever, which is, if you build a better mousetrap and the voters like the better mousetrap and some politician says, I want to take away the mousetrap, it ain't happening. And I think the same thing can play out with digital currencies.
Imagine spending an hour with the world's greatest traders. Imagine learning from their experiences, their successes, and their failures. Imagine no more. Welcome to Top Traders Unplugged, the place where you can learn from the best hedge fund managers in the world so you can take your manager due diligence or investment career to the next level. Before we begin today's conversation, remember to keep two things in mind. All the discussion we will have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their product before you make investment decisions. Here's your host, veteran hedge fund manager, Niels Kaastrup-Larsen.
For me, the best part of my podcasting journey has been the opportunity to speak to a huge range of extraordinary people from all around the world. In this series, I have invited one of them, namely Kevin Coldiron, to host a series of in-depth conversations to help uncover and explain new ideas to make you a better investor. In the series, Kevin will be speaking to authors of new books and research papers to better understand the global economy and the dynamics that shape it, so that we can all successfully navigate the challenges within it. And with that, please welcome Kevin Coldiron.
Okay, thanks Niels, and welcome everyone. So what is money going to look like in the coming decades? Who's going to control it? Could it be a private company? Could it be Amazon or Google? Could it be a country like China? Can banks survive in their current form if their special ability to create money is overtaken by one of these competitors? These questions might sound fantastical, but they're much more relevant and pressing than you might believe. And our guest today is the author of a new book that addresses them directly, including a detailed recommendation for how central banks like the Fed need to respond. The book is called Money in the 21st Century, Cheap, Mobile, and Digital. And the author is Richard Holden. Richard is professor of economics at the University of New South Wales in Sydney, and he's previously been on the faculty at University of Chicago and MIT. So, Richard, thanks so much for joining us, and welcome to the show.
Thank you.
So, before I ask my first question, I have to go off script a little bit, tell you about something that happened to me a few hours ago. We had a woman come in to tune our piano. And she's a musician, actually spends most of her time living in the mountains, hiking, meditating, that kind of person. Mm-hmm. And she tuned her piano, and when she's done, she gives me her Venmo QR code. And so I scan it, I pay her, it takes 5 seconds. And when we're finished, she says, yeah, I think cash is over. I think we're all going to be using digital money in the future, Bitcoin or something. And then she pauses again and she says, I don't know how banks are going to survive. They're going to have to change their business model. And I was like, well, yeah, I'm talking to a Harvard economist later today. So you're not alone in your view about the cashless society. Could you just start off by, giving us a quick overview of your background? How did you get interested in the future of money and the potential of moving to a society that doesn't have cash?
Yeah. So as you said, I'm a PhD economist. I did my PhD in the Harvard Economics Department and was on the faculty at MIT in Chicago. And I work in a range of different areas of economics, but my kind of core area is an area called contract theory, which is kind of like game theory, but where you get to design the rules of the game. And, that connects to finance quite a lot. So I've been studying and thinking about and writing about and working on issues to do with finance for 20 odd years. And, this topic really comes up a great deal. But to be honest, the way I really got into thinking more deeply about cashless societies and blockchains and the future of money was I write a column for the Australian Financial Review, the main newspaper in Australia. And January 2017, that's kind of summer vacation time here in Australia, on the other side of the world. And So everyone's kind of at the beach. It's like August in France kind of thing. And so the opinion page editor said, we want something a little more engaging, a little more fun for, early January, little sort of beach reading. You got something that's a little lighter. And I said, well, I think Australia and other countries are going to and could become like a fully cashless society. And I got a little kind of rough idea of a plan of how we could do that over 3 years if we really wanted to. And he said, yeah, that sounds pretty good. And so I wrote that on like the 2nd of January, 2017, and it got a lot of attention, positive and negative. A lot of people hate this idea. The kind of libertarian, anti-government types are not so jazzed about the idea of government money and no cash and no anonymity and things like that. Anyway, that got a bit of traction, and I sort of kept thinking about it and kept writing about it, and that's how I really got into ending up writing this book some years later.
And so you did the whole of 2017 without using cash, is that right?
Yeah, so I decided that, I kind of rarely used cash back at that time. Australia's pretty far down the curve on tap cards. It's been a long time since you had to use a magnetic strip or sign a thing on a credit card in Australia. We have, by virtue of a banking oligopoly where there are really 4 very large banks in Australia, they distribute the point of sale equipment like the EFTPOS terminals to every, your local convenience stores, sort of 7-Eleven equivalent, your local cafe, coffee shop. They all have these nice payment terminals and have had for a long time. So, you could tap with a card, and then of course when, Apple Pay came along, you tap with your phone, your watch and things like that. And so I never really wanted to carry cash around. It's kind of a pain. And so just to prove a point, after I wrote that article and I got a bunch of people saying, well, you don't understand, and what if there's a tsunami and the lights go out and all this kind of stuff. So I made a bet with a buddy of mine that I could go a year without using cash. And to be honest, it was the easiest bet ever to win. And I get it that I live in a major capital city and I'm kind of a bit more digitally engaged than, your average 80-year-old retiree and things like that. But it was the easiest thing ever. In fact, I'm not sure that I've ever used cash since then, and it's been several years since then, obviously. But that's part of the point, which is when the system is set up well for that, as it is in countries like Sweden and other European countries, and Australia and New Zealand and a bunch of other countries, it's very easy to go without using cash, and that has a whole lot of benefits for consumers and for businesses themselves.
What did you win in your bet?
Oh, I think I won a very nice bottle of red wine, so it was definitely worth it.
It wasn't a $20 bill then?
No, it wasn't a $20 bill.
You mentioned that libertarians hate the idea of a cashless society. So maybe before we get into kind of the guts of what you'd kind of like to see happen, what are the kind of benefits of cash, or when people argue for cash, well, what are they saying? Hey, we need cash because of this.
So I hear 2 main arguments. So one is anonymity. So, people aren't tracing, you take cash out of an ATM, you take out $400, or you can go spend $400 and no one's really going to know what you spent it on. So as I say, post writing this thing in 2017, after this column, I ended up on talkback radio a lot. And I'd never done a lot of talkback radio before, but, you get to engage with some pretty interesting characters, sometimes amusing, sometimes a little frightening, sometimes a bit of both. And, I remember one really stuck in my mind. This guy came on and he said, yeah, professor, it's like, I hear what you're saying, and it's so interesting, but there's one big problem. I said, okay, what's the big problem? And he said, look, if I don't have cash, when I go to a sex shop, my wife is going to know about it. She's going to see it on my bank statements and stuff. I say, yeah, I can see how that would be a problem, but, maybe the cashless thing isn't the root cause of the problem. It's the symptom, not the cause. But, people like their privacy for one reason or another, including people who, on the more libertarian right, and you've got more of these folks in the United States than we have in Australia, but, who think that the government is, going to track them down and all this kind of stuff. So I get that cash provides anonymity. Now, the flip side of that is cash provides anonymity for drug dealers and child traffickers and tax evaders and stuff. And to be honest, think that's much more of a problem than it is for people who are, cheating on their wives or freaking out about government unnecessarily. The other benefit that people point to, and I think this is a bit of a misnomer, but it's a very understandable thing to point to, is they say, hang on a minute, we have blackouts and brownouts and the network goes down. And, we had that tech crash recently around the world where, there was a software update and all of a sudden, you couldn't get it on an airplane and the banks were in trouble and stuff like that. That's totally a real thing. I often respond to that in a couple of ways. So one is to say, if there's a big, blackout, the way I put it is a bit sort of overly cute, which is if there's a tsunami, you're probably not out buying coffee, right? You're scrambling for higher ground. But the less glib way to put it is, if the power goes out, your local convenience store is shutting their doors, right? Power goes out is bad news if you're a small business owner. You're worried about, looting and various other things, and you're certainly not able to operate your business safely. So, you've got cash, that doesn't help you. No one's selling you anything in a big power outage or in the event of a natural disaster. The other thing that we saw, I thought interestingly, I don't know how widely this applied, but it was certainly true in Sydney, Australia. When that software update kind of brought down, a whole bunch of computer systems around the world, the local supermarkets, I went grocery shopping, and they said the only way you can pay is with a card, or a phone at these terminals because their cash registers are all digital, right? So they couldn't accept cash, but they could accept cards in this thing. So in a perverse way, actually cash is worse maybe in these kind of things. So I hear it's very natural to say, cash is anonymous and cash works when the power goes out, but I don't think that's actually true when you work through the details.
Yeah, I felt a little bit embarrassed as I was reading that section of your book because, I've got I won't say where, but I've got cash, stuffed in various places in my house just for that reason. And, but yeah, it's a bit like having gold, right? You're not going to walk down to the store and buy a loaf of bread with a gold coin either. So I think it's an important point. So your view is that, those kind of somewhat minor, I guess, objections aside, there's a lot of benefits to moving to a cashless society. And, if I got this right, and tell me if I do, you said there's kind of three ways that could happen. We could, a kind of existing cryptocurrency like Bitcoin or Ethereum could be sort of become the dominant currency, or a private digital currency issued by a company like Amazon or Google could become dominant, or a government-sponsored digital currency, a central bank digital currency managed by, say, the Fed or another central bank like China could take over. And my sense is that of the first two, you think it's much more likely that a private digital currency issued by a company could be a viable alternative, and that the way for governments to sort of counter that risk is almost like a preemptive strike, that to introduce their own central bank digital currency before that happens. And if that's done right, that you can sort of capture some of the benefit of digital currencies, that a private digital currency would deliver anyway. So I just wanted to, first of all, just ask if I've kind of got that summary right, broadly speaking.
Yeah, no, the summary is absolutely perfect. You put it much better than I do in the book. I should say to your listeners, yeah, there is a little bit more in the book, but that's basically the point. So please do read the book. No, that's a perfect summary. So just to unpack that, so first thing is, it's very unlikely that something like Bitcoin or Ethereum, in my view, is going to become a dominant digital currency for transaction purposes. Bitcoin, for instance, is a store of value for some people. Again, often people who want to keep their money outside of the view of, say, tax authorities or the like. So it's a store of value, but for transactional purposes, it's really kind of useless. The transaction costs are very high. It's closer to what you say about having a gold bar and wanting to go buy a loaf of bread with it, or even a car or something that spend $50,000, $100,000, it's still kind of hard to operationalize it. And when you work through actually like what you end up paying as sort of fees and charges effectively in order to do it's extremely high. And so people don't want to blow 10% of their money every time they go buy something. So I think Bitcoin and Ethereum are just kind of like poorly set up for transactional purposes. That's kind of like not their goal in a way. So they're designed in a way that makes them ineffective for that. Then there's a question about private digital currencies. And yeah, you're right. I point to, some of these big platform companies that have a pretty nice head start, like, Amazon or, it could be Apple or it could be a number of these other kind of platform-based companies. And the whole book starts actually with a meeting between Secretary of the Treasury Janet Yellen and Fed Chair Jay Powell in Janet Yellen's office, talking about whether they should let Facebook, as it then was, I guess it's Meta now, trial the digital currency they were proposing called Libra. They later rebadged it DM. But Facebook had gotten really far down the curve on getting this established. They'd got Visa and MasterCard to agree to be part of the consortium. They got a whole lot of really big vendors and kind of quasi-financial institutions or financial institutions to sign up to it. They had a really, really good marketing pitch, which was there's a ton of people, particularly in like sub-Saharan Africa and other parts of the less developed world or the developing world, that are unbanked, like don't have bank accounts and end up being unable to save very effectively, unable to transact very effectively, can be exploited to a great extent, who basically can't store the value of their labor and therefore, really get exploited at a very basic human level. And they basically said, we're going to bank the unbanked and we're going to make this better and we're going to solve the problems with some of the existing digital coins where you worry about how well backed they are. And there were some, high profile kind of bank runs on some of these coins that were meant to be totally safe that turned out weren't totally safe at all. And they said, we're going to put this thing in this Libra reserve and it's going to be in a basket of actual currency. And, we're just going to park the money with the US Treasury and park the money with the Bank of England and park the money in Japan and park the money in Australia. And it'll all be totally transparent. And they realized that they could make the money off of, controlling this currency. They didn't need to muck around with the reserve and trying to kind of skimp at the margin there. So they could be totally honest about that and say, well, hands above the table here. And they came breathtakingly close. In fact, it's well reported. I'm not breaking any news here. I tell the story in my own way. But, Jay Powell was kind of in favor of it and went to Janet Yellen and said, look, what's the harm here? Like, do a trial. And Yellen kind of thought about it and then came back and said, and Yellen's apart from being a, former Fed chair and a Treasury secretary, he was a very distinguished economics professor as well back in the day. And so the kind of economics professor in her kicked in and was like, hang on a minute. This isn't just a trial. This is like, the beginning of a kind of irreversible wave here where they get entrenched. And then, there's this thing economists talk about network externalities. And the way I always describe it is, think about Uber. And if you're a rider on Uber, it's good when there are lots of drivers on Uber because you don't have to wait very long to get picked up, right? And if anyone remembers Uber right at the start when it just started in your city, you wait like 12 minutes because there just weren't that many cars available. And it's kind of like, is this really better than a cab? Like, I'm not so sure. It's got the map. 12 minutes is kind of a long time. And then because there are all these riders, the drivers, well, it's pretty appealing to be a driver because there's lots of business out there. And this thing just feeds on itself to where in, most places now it's like, wait a minute, maybe 3 minutes, this kind of stuff. And so that's the power of network externalities. The more people that are on the platform, the more attractive it is to be on the platform. So the more people there are on the platform, it's this kind of virtuous circle. Well, that's what Yellen saw coming with with Facebook's currency Libra, which was you give them a foothold and then it's going to feed on itself just like a network, just like Uber or just like, any one of these other networks. And so she said, we better not let them get going. That's like one person making one decision that the world could look very, very different. And I, really wonder if one of these other companies, like an Apple or an Amazon, and I have a bit of fun with it, calling it, Bezos bucks and stuff like that, tried one of these digital currencies and took it out for a spin, it could get a foothold, and that would give them an enormous amount of power. And I've got a lot of admiration for what Mark Zuckerberg's done, and I don't mean to turn him into a piñata or attribute bad motivation or anything, but you can imagine if Libra is the digital wallet, if Libra had gotten a foothold and he's got this reserve where he's got hundreds of billions or trillions of dollars that he can allocate between US treasuries and British, government securities and Australia and so on. You can imagine it very easily being in a position to, again, I don't want to attribute bad motives to the guy, but you'd be in a position where you could say, hey, Australia, you make up 5% of the Libra reserve, but we're kind of thinking that, you've got some kind of quirky government policies. We're a little worried about sovereign risk, taxing your mining companies too much or something. We were thinking of making that like 2.5%. And that would lead to a massive run on the Australian dollar, create all kinds of problems. And you can imagine him saying, on the other hand, we're thinking about making a big investment in Australia, but we really think we should get some concessional tax treatment. And I don't want to be too cute about it, but it would put these, if you control a meaningful amount of the money in the world, it would give you enormous power to negotiate side deals with governments about your tax treatment or various other privileges you could get or not get. And governments would find it they might not like it, but it'd be totally rational for them to cave in on that. So I worry a lot about a private company having that kind of leverage. And I'm a pretty kind of centrist, markets are good, markets typically work kind of economist. So it's not like I'm anti-business, but I think handing business that kind of power would be pretty troubling. And then the last part in this very long-winded answer is, you talked about what about other governments controlling things. And what I talk about at some length in the book is, again, this is out there. This isn't kind of cutting edge reporting, but most people probably don't realize how far China has gotten in. They're not trialing a digital currency. It's called the ECNY, are rolling it out. I mean, there are hundreds and hundreds of millions of people in China who are using on a daily basis a government digital currency. And they are very clearly moving towards eliminating cash in China and making everything digital. And of course, with things like WeChat Pay and Alipay and things like that, this stuff can be used around the world. Now, I'm a professor at a university in Sydney, Australia. You might think like, well, how much does that affect somewhere like, well, we have quite a lot of international students, many of whom come from mainland China. All the food outlets on our campus, they all take WeChat Pay. They all take Alipay.
And so, just to be clear, are they getting paid in the Chinese electronic currency, or are they getting Aussie dollars?
The merchants are getting Aussie dollars, and they're doing the conversion. But you can easily imagine a situation where that tips.
But the merchant then needs to be able to spend those digital Chinese currency somewhere else in Sydney, right? So there has to be a network of merchants who all accept it.
Exactly.
Like their suppliers have to accept it. Their workers have to accept it. That seems like a fairly big hurdle.
It is a big hurdle. So that's why maybe the Amazon example is most instructive to see how that works here. So if you sell stuff on Amazon and Amazon say you got to take Bezos bucks, right? So what can you spend that on? Well, you can spend that on anything you like on Amazon. That's like a lot of stuff, right? Now, that's not your workers necessarily. It might not all happen in just one sort of fell swoop. But all of a sudden, it's like, well, maybe you buy a lot of your inputs to whatever you're selling on Amazon, or maybe a lot of your personal consumption is on Amazon. And you can imagine they say, well, you get like a 2% discount or a 3% discount, or maybe in the early days you get a 7% discount for spending Bezos bucks. So you get this whole kind of side economy using Bezos bucks. And because it's such a big platform, that's its own kind of economy. And you can imagine how that spills over. So how a government suddenly converts Australia into the Chinese digital currency, that takes a big step. But you can imagine sub-pockets of the economy working that way. So, we have Uber here. We don't have Lyft. We do have Didi, the Chinese ride-sharing company. Now, Didi actually do, in Sydney, Australia, take Chinese digital currency. And for a lot of people who are drivers on Didi, they want to buy stuff. That's the equivalent of buying stuff on Amazon. They want to buy stuff through Alibaba and other things. So they can buy, books and electronics and all kinds of stuff. So you can see how they probably don't want all their money in that, but, you get a quarter of your income in that and you're spending a quarter of your income in the Chinese digital currency, maybe that's better for you. So you can see how it gets a foothold, and once it gets a foothold, it can feed on itself.
Yeah, no, I appreciate that. Those are good examples. And I guess I was kind of working through in my own head, why couldn't, the government just, ban it? But like you say, say Trump gets elected and decides to greenlight, the Bezos bucks or whatever, Amazon starting their own digital currency, and then 4 years later, whoever comes in says it's not a good idea. Well, if it's got enough of a foothold, then you start getting people saying, hold on, I like these things.
Exactly. So, this was true in many cities around the world. I don't mean to be too Australian-centric, but I happen to know this example extremely well. When Uber, and I love Uber, and full disclosure, I've done a little work for Uber, so you can take that with a grain of salt as to whether I'm an impartial observer or not. I'll mention that in the interest of full disclosure. But, when Uber entered many markets, certainly true in Australia, they just entered and it wasn't legal. But, consumers really liked it. It was just like a much better product. Got things faster. You could see where your driver was on a map rather than, remember calling a cab and it was like, maybe it'll come in 20 minutes, get stuffed, and sort of, you had to call back and you're worried about making your flight or whatever it is, or your daughter's concert recital and all that kind of stuff. It was just a better product. And they got a foothold. And then, people started to complain, and a bunch of state governments in Australia came out and said, well, we want to ban it. And people were like, the voters were like, the hell, you're going to ban it? Like, don't take that away from us. So I think that's just one of the sort of timeless facts about superior technology, and I mean technology in a very broad sense. It doesn't have to be digital or whatever, which is, if you build a better mousetrap and the voters like the better mousetrap and some politician says, I want to take away the mousetrap, it ain't happening. And I think the same thing can play out with digital currencies.
Well, one more question that I want to move on to your, kind of recommendations for how we can head off that. Aren't there rules in the U.S., and maybe this is outdated, that kind of segregate or separate industrial companies from owning banks? So wouldn't that apply in this case?
Yep, there are. And, to go one step further, Apple have been quite clear that they're not really all that jazzed about getting in to all the regulation that's involved in becoming a bank. So they could set up a subsidiary. They partnered with Goldman Sachs to offer the Apple Card, for instance, right? And again, full disclosure, I have one of those, but I'm not sure it's been a wild success for either Apple or for Goldman Sachs. And they don't want to be subject to all that kind of regulation. Having said that, you can also imagine, firstly, rules and regulations change and are changeable. And when you've got a literally unlimited amount of money to lobby with, if you really want to get things done, you've probably got a pretty good shot. I think the other thing is it depends on the size of the prize. So I can understand why Apple sort of say, do we really want 10% of the credit card market, relative to our core business? We got a $2 or $3 trillion core business. What are we mucking around with that? If they sort of say, hang on a minute, we might be able to control the world, take it to what sounds like a ludicrous extreme, but, sort of think like Steve Jobs might have thought for a minute and say, hang on a minute, we got a plausible chance over the next decade or so to control the world's reserve currency. And that seems like a pretty big prize. That makes the iPhone market look kind of niche. And so I could imagine an Apple chief executive or a Bezos or someone like that saying, okay, it sounds extreme, but it also sounded kind of crazy that a digital bookseller would become what Amazon has come today. It sounded crazy that, the company that made the Mac would become the Apple of, today. And a lot of these, it's part of why they're successful. It's part of what's kind of remarkable about them. A lot of the, Silicon Valley folks, they don't think small. If you're thinking about colonizing Mars and kind of putting your money where your mouth is on that, and I don't know whether Elon Musk's going to succeed at that or not. It sounds kind of hard to me, but what do I know? That's one of the many reasons why Elon Musk is Elon Musk and I'm who I am. But these guys don't think small, and controlling the world's reserve digital currency, that sounds like kind of chump change relative to like colonizing Mars. So I don't know. I could see one of them taking a tilt at this.
Taking it on, yeah. Okay, so given that situation, your view is, hey, we shouldn't just wait for it to happen. We should say, okay, when I say we, I'm going to use the U.S. here just because that's the example you use in the book. We should create, I think you call it Fed coin. Is that right?
Yeah, yeah.
And that would be that would be kind of a central bank digital currency operated by the Fed with a lot of the same digital benefits, but still retaining the control over the currency, the power with the democratically elected government instead of a private company. So can you explain how that would work, how you think it should work, your particular suggestion for how that could be done?
Yeah, totally. So first, just to ground ideas and pick up on what you said, it's exactly right, which is I think the answer to what China's doing and what, private providers might try and do. And, we've already seen this kind of Facebook sort of failed attempt, but we should view it, I think, more as a very, very near success rather than some kind of failure. See it as a preview rather than something that's in the rearview mirror. Is for the Fed to preempt this. So yeah, you're right. I call it Fed coin for lack of a better term, and as a little bit of a play on Bitcoin. So it's the government should create its own central bank digital currency. I'll say a little bit about how that would work. Why do that? There's an offensive rationale and a defensive rationale. The defensive rationale is exactly what we've been talking about, which is don't let China become the world's reserve currency. That would be really bad for the US. The US gets a lot out of having the world's reserve currency. It gets to borrow a lot more and run massive deficits and borrow at very cheap rates. This is what a former French finance minister many decades ago called the exorbitant privilege, and that name has kind of stuck. And whether it's exorbitant or not, it's certainly a privilege, and the US is a great beneficiary from that. The other thing is there's all kinds of, I wouldn't even call it soft power. I'd call it kind of hard power. There's all kind of realpolitik that comes with, basically all the commodities in the world trading in US dollars and things like that. So in terms of international trade and the power that comes from that, so it's very valuable. So that's the kind of defensive rationale, is you don't want to lose that to either a private provider or to China. The offensive rationale comes from what's become known as Web 3. And, sort of Web 2 was like the internet and stuff and digital commerce and so on. And Web 3 is basically smart contracts and programmable money. And that's, if you've heard of DeFi or decentralized finance, that's what this stuff is. And it includes things like instantaneous currency transfers from, Kiwi dollars to British pounds instantaneously for free, compared to that taking like 3 to 5 business days and costing, meaningful amounts or annoyingly meaningful amounts of money and so on. And so all of that kind of stuff is powered by, at the moment, the way that's done is it's powered by blockchain technology. And that was the rationale for, and I talk about one of the three protagonists in the book as I tell the story through the lens of Janet Yellen, Raghu Rajan, who was, I had the great privilege of being his colleague at the University of Chicago for several years. And he was also, he ran the Central Bank of India for a while. And so he's one of the other characters. But the third character is a guy called Vitalik Buterin, who was the founder of Ethereum and is the closest thing to the kind of god of the blockchain and cryptocurrency world. And he had this really good idea, which was, Bitcoin's just a coin and, it's a store of value. And as we talked about, it's not that useful for transacting. He said, well, what if you put like a programming language on top of a Bitcoin type thing and allow people to write smart contracts? And this, he invented that idea basically. So I can write a computer script that's kind of self-executing. We don't need a court of law to adjudicate the contract. We don't need to adduce evidence about whether you performed your bit of it. If I want to write, for instance, an insurance contract on a weather event that's verifiable by, stuff that's in the public domain, what was the wind speed of a cyclone? How much did it rain in, Boise on a particular day or whatever, which are very useful. These contracts happen all the time for kind of risk sharing purposes and so on. You can just write those as part of a computer script and a smart contract. That's becoming a bigger and bigger thing, these smart contracts, DeFi, and so on. This is the offensive rationale for a Fed coin, which is create a coin that's got all these programmable money features and you can smart contract with, but that doesn't have the downside of the anonymity of the blockchain so that it can be used for nefarious purposes, criminal purposes, money laundering, all that kind of stuff, but has the upside of being able to be used for digital contracting. And the key design feature here is there's no need, if the Fed's going to do this, there's no need to use a decentralized ledger, that's what a blockchain is. Everyone holds the ledger and you use cryptography essentially to create trust in it. If you've got the Fed running it, you can have a centralized ledger. So you don't need to have people running around mining Bitcoin, using tons of energy, maybe causing environmental damage. But mainly just using a lot of energy. It's very costly. The Fed, even the crazy libertarian guys, they still trust the Fed to the degree that they're willing to hold US dollar banknotes, right? And so there is already, a lot of trust in this centralized authority, the Federal Reserve. And they could just change paper currency into digital currency. And there's your Fed coin run on a centralized ledger. And, you'd basically just have an app on your phone, and your bank account would tell you you've got this many US dollars would look exactly the same, but everything would transact digitally, and there'd just be no paper currency sloshing around. There'd just be digital currency, as there currently is quite a lot of, in a sense anyway, sloshing around in the economy. Now, there's one kind of serious wrinkle with that. I mean, there's the politics of how you would ever get that done, given the distrust that a meaningful portion of the population have of government. And I don't want to get into the politics around the upcoming election, but you can imagine that a certain portion of the electorate that are going to vote a certain way probably aren't so enthusiastic about empowering the federal government more. But let me just bracket that for now. And that's less so in a bunch of other countries. That's like not true in England or Australia or New Zealand or Canada or, various other countries. But let's set that aside. Commercial banks would be in a different position here. So commercial banks, and you mentioned this right at the start, again, this is well known, but kind of, unless you're really in the weeds of how the banking system works, people might not be quite so aware of this. Actually, individual banks, whether it's Chase Manhattan or, your run-of-the-mill savings and loan, they actually can create money. And that sounds weird to people, but, here's an example of how it works. So imagine you go get a mortgage for $400,000. So what does your bank do when they give you a mortgage for $400,000?
I'm in California, so we better increase that number.
Yeah. Let's. I didn't want to go with too big a number, but I'm in Sydney, Australia, so $400,000 buys you like a parking space here. So let's call it $1 million. Keep a round number. So you borrow $1 million. Well, what does the bank do? Well, what they actually do is they credit and they create an account for you, and they create two accounts. They create a mortgage account that says, you owe us $1 million. And, we're going to you got to make these monthly payments. And they create a second account where they put $1 million in it, right? And the money pretty quickly gets sucked out of that to go pay the vendor for the seller for the house that you buy. But what have they done in that transaction, right? It's good old double entry bookkeeping. Credit $1 million, debit $1 million. They just created $1 million out of thin air. And that's the way that works. Now, what if so banks are doing two things here, right? They're acting as intermediaries. They're matching up lenders and borrowers, right? So what happened when they lent you $1 million? Well, it's really hard for me or you to go and find somebody to lend us $1 million or a whole bunch of people to lend us $1,000 each, and 1,000 people lending $1,000. That's like kind of hard. So they intermediate that. They find people who are willing to, put money on deposit or have CDs or, bond investors who they can sell bonds to, and then they lend it. So they borrow from depositors and bondholders, and they lend to mortgagees. And so they do that. They're acting as an intermediary. The second thing they're doing is they're acting as credit creators. Now go to the world where there's Fed coin. Well, the Fed creates the money supply there. They say, this is how many Fed coins are out there, okay? And, it might be trillions and trillions of them, but it's like, this is how much Fed coin they're out there. So the commercial banks no longer get to create that. So they're no longer credit creators. They're still intermediaries. So what do?
What happens in that world? This is what a question, I'm glad you brought this up, that I really wanted to ask, which is, what happens in that world when I walk into the bank and say, I want a mortgage? Does the bank have to then go to the Fed and say, hey, can Kevin get a mortgage? Or or do they just give you the mortgage and then the Fed's sort of just assumes that their credit process is good? Do you know what I mean?
I totally know what you mean. From your perspective as a borrower, everything's going to look exactly the same. Behind the scenes at the bank, what they do is, instead of magicking up the money by the process of debits and credits we talked about just before, what they do is they go to the Fed and say, I want $1 million. Now, they don't have to say, I'm going to give it to Kevin and trust me, he's good. It's still on their books, right? So what they do is they just borrow $1 million from the Fed, right? And the Fed decides on what the money supply is. That's the same as them setting the interest rate. So they do this already, which is they lend money to commercial banks, okay? And commercial banks have money on deposit with them. And that's exactly what setting the federal funds rate does. So they would just go to the Fed and they would say, oh, the federal funds rate, say 4%. It's a little higher at the moment, but it's probably coming down soon. They say, oh, I can borrow from the Fed at 4%. And then they say, well, Kevin's a really good credit risk, and he's not borrowing 100% of the value of his home. He's only borrowing 70%. And he's got a good income, and he's always paid back his debts. And he's got a great credit score. I'm going to charge him a 1.5% premium. I'm going to charge him 5.5% for his mortgage. And I lend to him, and I make 150 basis points as the bank on the way through. That's effectively what the economics of what happens to their income statement at the moment. They're borrowing and lending. But just what they're not doing in FedCoin world in the future, as I see it, is they're not creating money. So the Fed is controlling the money supply rather than commercial banks having a meaningful role in the creation of credit and therefore the amount of money sloshing around. Now, they make some money out of that at the moment. The commercial banks make some money out of creating credit, the same way that the government makes money out of printing bills. It costs not very much to print a $50 bill, but, people are willing to, it's worth $50. And that difference is, roughly speaking, that difference is what's known as seigniorage. And banks, commercial banks, basically earn a different kind, but it's fundamentally economically the same thing. They earn seigniorage at the moment by creating credit. That money would go away. It's not the lion's share of their economics. The lion's share is the 150 or 200 basis points spread that they earn on lending the money out to you and taking the credit risk. But they would lose a bit of money from that. And, you'd have to figure out a way to make sure that the commercial banks didn't freak out too much about that. But that's the process of what would happen. That's the mechanics of what would happen.
Okay, I just want to circle back, make sure I understand. How is the Fed controlling credit in that world unless they are saying no to banks, or unless they are saying, hey, there's a stock of loans that we're going to kind of allow to be created this year, and then banks can, that will be a limit, because otherwise, it seems to me that the Fed either has to have some ability to reject new loans, or else commercial banks are just creating credit in the same way they do now. Maybe I'm not fully understanding.
So it's a great question. So think of it this way. And this is actually how it worked. We're actually going back to how it worked in kind of the Volcker era. So think of it this way. Right now, what the Fed does is it sets the price of money through the federal funds rate, and then the market clears. There's supply and demand. They set the price, and the intersection of the supply and demand curve for money basically tells you what the quantity is. So, think about your kind of like undergraduate principles course in economics. You got price on the vertical axis and quantity on the horizontal axis. You got a demand curve that slopes down, a supply curve that slopes up. You take the intersection point and you can translate price into quantity. What happens now in the new Fed coin world? The Fed sets the quantity of money. They say they're going to be this much amount of money, this many Fed coins. And now you just start on the horizontal axis and you say, I know what the quantity is. Now I can kind of like go up, hit the intersection of the supply and demand. That tells me what the price is. So we move from a world where the Fed sets the price of money and the quantity is kind of the outcome, to they set the quantity of money and price, the federal funds rate, is the outcome. That's how it used to work, kind of, the sort of Volcker, pre-Volcker era. And so it's a different world, but it's not a totally unfamiliar one. And of course, it's not like this stuff is, firstly, they're adjusting these things in kind of real time. And it's not really a mystery. So it's not like, oh, we set the quantity and, who knows what the federal funds rate is going to shake out to be. Oh, we thought it was going to be 4% and it's actually 21%. They know what it is at the moment. They know what's clearing the market. They know what the conditions are. So they're just adjusting this around. We're talking about kind of micro movements here. But that's the difference. It's right now, they tell you the price and quantity is what shakes out of the system. In the Fed coin world, they tell you the quantity and price is what shake out of the system.
So from an individual's perspective, putting monetary policy aside, really the difference is that, you still have your account at whatever bank you choose to hold. You just have an account that's denominated in these Fed coin tokens as opposed to bank deposits. And these tokens then can become used as part of smart contracts in a way that, say, dollars aren't so easily done now, because there's presumably like a programming language or capability built around that.
100%. So from a consumer perspective, you wouldn't even really know the difference, which is you just look at your bank account and it's, it's not going to have a different symbol, and it wouldn't even really say coins. It would just say US dollars. So you just look at your checking account and say, I got $2,100 in my checking account. It's just the same as before. And you can spend it in all the same ways. It's just you can't write checks and you can't get cash out. But you can use a card, you can use your phone, you can use your watch, you can use whatever. To do that, you can use your online banking to transfer it to somebody else. You can use Venmo. You can, all the only thing is you can't use banknotes and quarters and stuff. And then there's the layer on top, which is the kind of the Web3 Ethereum programmable, the smart contract stuff, where because you've got this much more efficient system, I think you'd see Web3 really flourish. I think one of the things I talk about is there's this big chicken and egg problem with Web3. In a way, it's kind of remarkable that smart contracts have got as far as they have, because you've got to use Ethereum, so Ether, the Ethereum digital currency. Now, I've done some stuff with that as kind of proof of concept. And it's kind of like a pain. You got to go through an exchange. You got to exchange US dollars for this stuff. It's kind of expensive. The transaction costs are high. Then this thing moves around wildly. So, you could make or lose. Your money could halve or double, but, in a week. between when you take it in, take it out. So I've done some research with this stuff around how to design smart contracts, and fine, I spend $2,000 and it's for a kind of scientific purpose. But, I'd feel a lot more nervous if I was, using it on a day-to-day basis, right? The great advantage of something like Fedcoin is it'd be super stable, so you wouldn't have these big wild price swings. And then you could imagine people much more likely to develop very useful smart contracts for people, because there would be this user base for it. It's like this network externality thing. It's just like suddenly there's an Uber that like kind of works that people want to use, and that becomes a self-fulfilling prophecy. And so part of what's difficult, I try in the book to foreshadow some of the things that could be done in the future. Part of what's hard about this is, I said before, an obvious statement, there's a reason that Elon Musk is who he is, and there's a reason I am who I am. I can't really envision the kind of amazing innovation that will happen with smart contracts and digital money in the future, because until we have the tools to do it, we haven't seen what really creative young people can do with this stuff. But what I know for sure is that you give them the right set of tools. I mean, this movie we've seen before. You give people the right set of tools and amazing things will happen. That's what happened with personal computers. That's what happened with, programming languages going all the way back to BASIC. And just look at the apps on your smartphone. That's what happens when Steve Jobs, in 2008 releases the iPhone 3G and the App Store opens up. All of a sudden, people dream up amazing things, including, by the way, Uber, and, who knew that like online dating would be a thing. It's kind of it's hard for me to imagine the future, but I'm pretty sure it'll be interesting and exciting and possibly mind-blowing.
And are you active in you're back in Australia? Are you active in trying to get the Australian government to do something like this? I mean, it strikes me that, well, if I just think back to, say, like the history of, I don't know, meaningful changes in, say, the way central banks operate. Oftentimes it's small central banks that start something and then bigger ones imitate them. Like New Zealand, I think, was the first central bank to do inflation targeting. And that was like, hey, that works. Maybe we should do it. Are you working with the Australian government or trying to work with them to get this going down there? Are you? Yeah.
Yeah. So I do some stuff behind the scenes. I don't like to overestimate my influence. I have a weekly newspaper column in the main financial newspaper that affords me a little more influence than I say with a degree of chagrin that I have as a lowly university economics professor. So yeah, I get to make the case. Like a lot of central banks around the world, this is well known, it's public information. The Reserve Bank of Australia, have been studying this and thinking about what it would look like, and they've been doing that long before, I started rabbiting on about it. But I think there's a real opportunity for Australia. I do think, and that's, to be honest, that's really the main reason I wrote this book. And I've said to some people before that I hadn't in many. I hope plenty of people will read the book, but in a sense, this is a book for an audience of one, and that one is Janet Yellen, and whoever ends up succeeding her as Treasury Secretary in due course, I suppose. Which is, it will take a Treasury Secretary and a Fed chair, obviously with an administration that would be supportive of this, to push this in the United States. The US has the most to lose and the most to gain from really pushing this hard. If I could predict the future of US politics, I wouldn't be an economics professor. I'd be on a beach in Malibu or something. But I think administrations of both political persuasions, if you like, have a rationale for being concerned about the what I say is the defensive rationale, the threat from China, which I think is very real, and to in another way the threat from private providers. But I think the China thing is enough for administrations of either a Democratic or a Republican flavor to take very seriously and think about what the rationale for that is. And I don't think they're going to get very far with UN resolutions or kind of wagging their finger at China and asking them to do that. If they could do that, there'd be all sorts of other things that wouldn't be going on, and people in Taiwan wouldn't be freaking out about their future and so on. So I think the answer here is to compete, not to try and negotiate. And I think the U.S. leadership is really important here, and I suspect that's the way it'll go, rather than an Australia or a New Zealand being the trigger. But you never know, and you're quite right. I mean, inflation targeting came out of New Zealand, and it's been one of the most, it's probably the most important practical thing that's happened in macroeconomics in half a century. And Australians are very competitive with Kiwis, so it kind of, in some sense, it pains me as a true blue Aussie to say this, but hats off to New Zealand for that, because they did invent inflation targeting. They showed it could work, and it's been an important thing around the world.
Hey, well, now you got your chance with the digital currency, so you got a chance to outdo them.
I'll have to tell the governor of the Reserve Bank that that's the rationale. We can't lose to the Kiwis twice in a row.
We already lost once 50 years ago. Well, it strikes me, and I know we've got to wrap up here. It strikes me that it will be, I think, when the challenge to U.S. power becomes manifest, that it'll probably start getting taken more seriously. And that could be through, a private currency getting a foothold. It could be through China's currency getting a foothold. It could be a combination of both. It'll be interesting. But I encourage everyone, again, the book is called Money in the 21st Century. There's, we kind of focused on the Fed coin part of it, but there's a lot more in it. If you want to learn about how Bitcoin works, if you want to learn a little bit about what countries like India have done in terms of moving to a cashless society, there's a lot to learn in this book, and I think it's a topic that we're going to be talking about for a while. So it's good to get in there and learn now. So Richard, thanks so much for joining us. It's really been a tremendous conversation. Appreciate having you on the show.
Thanks, Kevin, for a great conversation. I really enjoyed it.
Make sure you follow Richard's work. You can tell from our conversation, I think a lot of things we've been talking about haven't been discussed enough yet on mainstream media. So for all of us here at Top Traders Unplugged, thanks for joining us, and we'll see you next time.
Thanks for listening to Top Traders Unplugged. If you feel you learned something of value from today's episode, the best way to stay updated is to go on over to iTunes and subscribe to the show so that you'll be sure to get all the new episodes as they're released. We have some amazing guests lined up for you, and to ensure our show continues to grow, please leave us an honest rating and review in iTunes. It only takes a minute, and it's the best way to show us you love the podcast. We'll see you next time on Top Traders Unplugged.